Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Yeah, U.S. crude futures pierced $85 for the first time, going all the way back to October. It's the latest milestone in a market rallying against a backdrop of OPEC plus cuts, strong demand, and heightened geopolitical risk. That geopolitical risk, specifically the war in the Middle East, has injected an additional premium to prices, underscored by an Israeli airstrike on Iran's embassy in Syria that killed a top military commander. Iran vowing revenge on Israel for the attack.
Yeah, these are among our most read stories on the Bloomberg. Let's get to the interview. With us is Ted Singer, former senior U.S. intelligence officer with the CIA, including chief of Middle East operations and 5-time chief of station. Ted is with us from Virginia. Ted, great to have you here on Bloomberg. We have used the word, I feel like, escalation or escalating many times since the initial attack back on October 7th, that attack by Hamas on Israel. In addition to kind of what we are seeing today, are we escalating? Have we escalated? How would you describe what is happening currently here in the Middle East and how far it's come?
Well, the news overnight comes just as we're about to hit the 6-month anniversary of Hamas's brutal attack on October 7th of last year. And the two big stories overnight were first, of course, as you've spoken, the reported Israeli strike against an Iranian diplomatic facility smack downtown in Damascus, the capital of Syria. The target appeared to be a very senior Iranian Revolutionary Guard Corps Quds Force commander by the name of Mohammad Reza Zahedeh. He's probably the most senior Iranian figure that has been killed on the battlefield since the U.S. killed Qasem Soleimani in 2020. So the decision on how and where and when to retaliate is in the hands of Iran right now, and that will in turn beget what the cycle of escalation may or may not be. The second story overnight, as you've heard, the Prime Minister of Israel and the Israeli Defense Forces have publicly acknowledged the tragic accidental airstrikes against international and Palestinian aid workers working for the World Central Kitchen. This is just going to augment and pump up the sort of rhetoric and, let's say, Muslim sentiments during the holy month of Ramadan about the humanitarian crisis that is unfolding before the world's eyes in Gaza. So those two things come just as the U.S. and Israel were seemingly putting behind them some of the public sort of friction about the unfolding humanitarian crisis, Israel's plans and intentions to launch a ground operation in Rafah, which is in southern Gaza, where about 1 to 1.5 million displaced Palestinians have been seeking refuge. That crisis, sort of public spat, was joyous news to Iran's ears.
Right.
And heretofore, they've sort of been taking a back seat in terms of public retaliation or escalatory steps against Israel, because in some ways they were winning the hearts and minds, meaning the spat between Israel and its major ally, which is playing out in the media, which is playing out in our political elected halls of leadership, was sort of music to Iran's ears. Meanwhile, they're selling oil galore, if not weapons, drones, if not missiles, to Russia, oil to China. So in some ways, they were enjoying watching this fight from afar, allowing their proxies to take periodic strikes, whether in the Red Sea or elsewhere, against U.S. or Israeli forces. But now they're on the record of saying they are going to retaliate. Yes, ma'am.
Ted, no. Yeah, we're talking with Ted Singer. We're all just kind of listening and kind of sitting on the edge of our seat. Ted Singer, former senior U.S. intelligence officer with the CIA, as we said, including chief of Middle East operations and 5-time chief of station, still with us from Virginia, someone who knows a lot about this region. We've only got about 5.5 minutes left, so I want to kind of cut to the chase a little bit, Ted. I mean, there's a lot going on, and we don't laugh when we say we feel like we need a whiteboard on so many different parties and different hotspots and attacks that are going on around the world. We have had guests on who say there's more than 100 attacks of things. So we're already at World War III. I don't want to be inflammatory, if you will, but if you were giving the U.S. president a briefing today, what would you say? And just kind of briefly, if you would.
Israel is going to need some latitude to complete its military operation in Rafah. Benjamin Netanyahu is on the record. The Israeli population is demanding the return of those hostages and the decapitation of Hamas. There will be humanitarian impact by launching those operations, but for this conflict to come to a conclusion, he's going to have to go into Rafah to secure the release of those hostages and to decapitate the leadership of Hamas. Yahya Sinwar, the planner, his military aide, Mohammed Daif, are both still alive and walking on this earth. The Israelis will need to complete that operation before they can look to rebuilding and reconstructing Palestine.
Well, that's what I want to talk about, Ted. What happens after that? Let's say Israel is successful in that operation, in that, in your words, decapitation of Hamas. What then happens? How does a rebuilding happen?
Well, I think behind the scenes, you have seen the Gulf states, whether that's Saudi Arabia, that's the United Arab Emirates, that's Qatar, who have the money, the wherewithal, the sort of religious credentials. They are going to be essential to rebuilding and reconstituting something livable in Gaza the day after. Their price that they will demand of Benjamin Netanyahu will be some sort of process that passes a giggle test that heads towards a two-state solution. Very soon, Prime Minister Netanyahu is going to have to accede to that. Behind the scenes, we're watching the U.S. and its Arab allies engage the Palestinian Authority to make its own necessary changes, tweaks, personnel assignments, so that they can be a viable sort of partner in the reconstruction of something in Gaza when the Israeli operations are over. So Arab states, their money, their wherewithal, and the Palestinian Authority and the United States and the European Union are all putting significant pressure on Israel to move towards some sort of process that passes the giggle test, not just another roadmap on the roadmap to the roadmap of Middle East peace, but something tangible that will lead to a two-state solution.
Yeah, I've gotten a lot older talking about peace in the Middle East because we have been there before many times.
Yep.
I hate to use this phrase because it's overused as well, but is there something that's different this time around that makes you have hope that there would be that two-state solution, which seems to be, as many that we have talked to, seems to be the only way forward, the only really viable way forward?
I too have suffered my share of lost hope. So you're not talking to an optimist. The slim glimmer of hope here is that the recognition by Saudi Arabia of Israel would be a significant game changer in the Middle East.
Yeah.
Saudi Arabia, its size, its population, its wealth, its oil production was not a signature to the Abraham Accords.
Right.
Bringing them in to the fold as the custodian of the two holy shrines of Islam would be a game changer. And that golden ticket is in Crown Prince Mohammed bin Salman's hands right now. And Prime Minister Benjamin Netanyahu knows that.
Hey.
So I don't think he can squander that golden ticket at this moment.
Yeah. Hey, we've only got 30 seconds, and I've got to ask you, because you brought up Iran, Russia, oil. Does Russia want to see a resolution to this, or have they just enjoyed this distraction? And forgive me, that's a terrible way of describing it. We've only got about 30 seconds left here.
Yeah, you described it completely perfectly. They've been enjoying watching the show, watching the U.S. and its ally Israel at odds, and watching us distracted by yet another crisis that's not focused on Russia, not focused on Taiwan. They're learning a lot of tactics and procedures as well, just by watching the show.
Well, listen, we so appreciate your time today. Look forward to reaching out to you again in the future. Ted Singer, former senior U.S. intelligence officer with the CIA, on the latest in the Middle East. So a lot going on.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, we want to focus all in on cars. Tesla, of course, shares, as we just heard, down around 5%. It is the biggest decliner, Tim, in the NASDAQ 100.
Yeah, this coming as Tesla suffered its first year-over-year sales drop since the early days of the COVID pandemic. First quarter deliveries disappointed in Tesla's biggest miss ever. Meantime, Americans who are out shopping for cars, well, they're looking for bargains right now. To our auto roundtable we go. Back with us, we got a Bloomberg TV co-host of Bloomberg Technology, Ed Ludlow. He's here in our studio, along with Bloomberg News auto reporter Gabby Coppola joining us from Michigan. Ed, I want to start with you and just talk about Tesla. We talked about it yesterday. We knew the numbers weren't going to be pretty, but they were even uglier, I think, than pretty much every analyst thought they'd be.
Yeah, it depends ugly in whose eyes, but in the analysts, certainly, I think there's probably a few sell-siders around the country scrambling to rethink their models and what they thought Tesla would grow as. But the way that I look at it is it's the biggest deliveries miss against Bloomberg consensus, at least, which is the average we take of analyst estimates on record. And then you start to ask, well, why did we get this so wrong? What was it that happened in the quarter that led to this strange low deliveries number? And Tesla put in its statement a lot of supply side factors, diverting shipments of parts and finished goods because of the situation in the Red Sea, a pause of production in Berlin because of what they called an arson attack, and then a new Model 3 in Fremont, my hometown in the Bay Area, impacting production.
This is that ramp up that they referred to?
Right, but how does that...
Are you skeptical?
I'm talking, the voice of the market is speaking through me. How does that answer why the deliveries were so low? Maybe production, which also missed estimates. But what happened here? And I think the answer is demand.
Well, and that gets to the bigger micro story, right? In terms of EVs still growing, but not the uptick we all expected. Correct, Ed?
Exactly. So the correct way to state it is there is still growth in EV sales. It's decelerating. So we have a lower pace of growth this year than last. I think that what you read more consistently today, right now, the reaction to Tesla is the impact of higher rates and the consumer started to be felt in the first quarter. Then I look at Gabby Coppola's fantastic reporting. What was popular in the first quarter? Cheap combustion engine cars.
Well, all right, Gabby, there's our perfect setup for you. So come on in. Your story is great, and it gets into what Americans are up to. They're looking for a deal. They're looking for a bargain if they're out there shopping for a car.
Yeah, it was really striking to me because for so long on this beat, I remember talking about how Americans just seem to have bottomless appetite for, pickup trucks that were going more upscale with luxury interiors, and the whole market was shifting from sedans to SUVs because everybody wanted an SUV. And now I think, the interest rates are really starting to bite, but people still need transportation. So that's what you're seeing. I mean, I was struck by Toyota, had really, strong sales results. I think their sales were up 20% quarter on quarter. But what was interesting to me is that their sedan sales actually grew just about the same as their SUV sales. So, I mean, it shows you that sedans are often, unless they're like a luxury car, they're less expensive than an SUV. They're smaller, more compact models, things like that. And that's what I think the bottom line, like the payment, the monthly payment on your car is what's really curbing people's interest. They still need to buy something, but they just can't afford a lot of what's out there.
Yeah, so that brings us back to
Wait, the recent car buyer?
Yeah, the recent car buyer at Ludlow.
I don't know if Gabby's in on the gossip or
yesterday.
Oh, what'd you get, Ed?
I got a Model Y. Sorry.
Before the end of the quarter. Before the end of the quarter.
So, Gabby, I picked up a Model Y last Thursday, and I did it because my wife and I needed a new car. And as you know, I've been driving a Tiguan around, Volkswagen SUV, for the last 3 years. And the lease price, $300 a month.
For the Tesla.
For the Tesla Model Y, and that reflects the federal tax credit, but also the incentives that Tesla took off its own back, the discounting. But Gabby, it's still the same point that Gabby's making, right? It's economics. And the consistent thing that the sell side, the autos analysts, whoever it is saying after Tesla's numbers came out is we're starting to realize that the market for Y and 3, or simply put, smaller cars that are 40 to 50,000 US dollars, it's just not there anymore. So when's the next Tesla thing coming? Cybertruck's a niche product, funky but niche, and the $25,000 EV that I think a lot of people really want is a long way away. Right. That's the story here.
So Gabby, come on back. Go ahead.
Yeah. No, I was just going to say that I agree that price and cost is really the story. But I do wonder if when it comes to the demand for EVs, if we still have things like range anxiety or, just the lack of charging infrastructure, if that also is holding things back. I mean, I hear that a lot from automakers. Of course, everybody wants to give excuses for why their cars aren't selling well. But, I just think that when you look at the EV side of things, I don't know if price will cure everything. I know Tesla has a much better charging network than any of its competitors here in the U.S., but that network is also being opened to a lot of other brands now. So you hear stories of Tesla owners kind of grumbling that they have to share now. I'm just going to say, I don't know if that's, there may be more to it than just the price.
It's interesting because I feel like we've talked with Keith Naughton, right, about how the hybrids, right?
Yeah.
The hybrid sales have gone up. So people are interested in doing kind of the right thing for the environment, but they don't want to be caught
but that's also
where they're stuck somewhere.
That's an economic decision as well, because if you're having a car with better gas mileage, then you don't have to visit the pump as much. And mileage has improved a lot in recent years, Gabby.
Yeah, it has. And, maybe I'm cynical or I've been covering this beat too long, but I feel like doing what's right for the planet, for some people, maybe that is like a leading factor of why they choose a car. But most people, want a car that meets their needs. And like what you were just saying, like about its economics too. Gas is still, it's not that cheap still. And if you can get better gas mileage driving in electric mode, and I think, like Toyota will make this point that like a lot of their hybrids are competitive with the price of a combustion engine car. So once you get to parity and you're offering people savings on gas, then that's really appealing, and then you have a gas tank to deal with your range anxiety. But to Ed's point, I think you can get some great deals on leased EVs right now if you do want to go that route.
The root of what Gabby and I are reporting on is reflected in the sales data and it's reflected in the analyst notes is the economic reality for a lot of households. Yes, my lease is $300 a month. It's significantly less than the last lease I had on a big combustion SUV. To charge in the middle of the day at 35 cents kilowatt hour, this was about midday Pacific time on Friday of last week, to get from 25% state of charge to 80 was about $10. To fill up my gas car is about $80 at the moment. But there is also some fetters. I've only got 10,000 miles a year on the lease. Well, what if you commute 60 miles every day? You're not going to have enough miles in the year to net out and do it. And then, we talked about it a little bit yesterday, I think, but if you then get yourself an EV and you want to install a charger at home, you have a very significant income cap on the state and federal incentives available to help you rebate or pay for that charger. It's not straightforward. I sympathize for any consumer who's like, how do I even get started?
Yeah, it's difficult. Go ahead, Gabby.
Well, there's just one other point I was going to bring up that Ed reminded me. People are also experiencing negative equity, meaning that the auto market is so weird right now, right? Like the pandemic created all these distortions. There were supply chain snarls. There were severe shortages of cars. So dealers were charging over MSRP. People were paying through the nose for a new car. Now, 2 years later, production is normalizing. So used car prices are coming down, and a lot of people are being stuck with their car underwater. I talked to a guy who actually bought a Tesla Model S that now has $40,000 worth of negative equity in that vehicle, and the only way he can trade it in is if he pays Tesla $40,000. He's like, I want a new car. I love Tesla. I love my car, but I have to, cough up $40,000 if I want to trade this in. So I don't think that's a huge drag yet, but it's certainly something that I'm watching. I think because the dealers who chose to do that, they said, I'm going to do what the market will bear. I can charge over MSRP. Well, now when you want to get that person into a new car 3 years later, good luck, because now you've got to be able to roll over all the debt they have that they took on to pay that price you charged.
Yeah,
so that's
painful.
like another factor to kind of, think about as we look at the health of the new car market this year.
Okay, so let's end where we began, and that's with Tesla, but thinking, Ed, about how the company moves forward from here. With the outlook that we understand for the EV market, not just here in the US, but globally, of the challenges that Gabby just talked about.
Yeah.
What's the company's strategy here?
I take Elon Musk at face value, and that is that Tesla's between two waves. So it's an acknowledgement that the growth they saw built on Model Y and 3 mass market vehicles has kind of been and gone. The next wave is the $25,000 price point car, which many more Americans, but also Chinese and Europeans can afford. But then also acknowledge the big cohort of investors that don't give a damn about the deliveries. They're only focused on the software story. And you have to give credit where credit's due, and their financials will show that software has a role to play for them.
A sector that just continues to be fascinating. Guys, thank you so much. Really terrific stuff. Bloomberg TV's co-host of Bloomberg Technology, Ed Ludlow, here in studio, along with Bloomberg News auto reporter Gabby Coppola.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We look at a lot of different indicators, right, Tim, in terms of the health of a market. We talk about the IPO market. We talk about M&A deal activity. And we've had a couple of things happening today when it comes to the deal environment.
Yeah, the one happening most recently, just before we went live, was Endeavor Group Holdings. The talent agency, it's also the controlling investor in WWE and UFC Ultimate Fighting Championship, agreed to be acquired by the private equity group Silver Lake Management in a roughly $13 billion buyout. And then there was another one happening just this morning, Carol.
Yeah, exactly. And this was in the energy sector. And I was looking at on the Bloomberg, the MA function, just looking at kind of deal activity, which we know really around the globe is down year over year, except for North America, which is up about 17% from 12 months ago. So we're seeing a little bit of an uptick. And where a lot of deals are happening, it turns out, in the energy sector. And we've certainly reported on them. Today, we had SLB agreed to acquire rival oilfield service provider Champion X for $7.8 billion.
SLB, the company formerly known as Schlumberger.
Or we used to call Schlumberger in the newsroom. But no, we mean Schlumberger. But you're right, SLB now. All-stock deal, a move that will bulk up SLB's portfolio as aging shale fields prompt U.S. drillers, to look for better technology to maintain oil and gas production. So it's interesting, though. We've seen, despite, we just talked about EVs, right? And kind of a pushback for the last couple of years against fossil fuels. We still see the major energy players doing deals in this sector.
It's incredible to see.
Amping up their
just over the
exposure.
last 6 months, the deals that we've seen when it comes to the energy space, absolutely huge deals that have totally reshaped it. But it's not just energy deals that are happening. And like you said, Carol, we look at this as a metric of the health of the overall economy, in addition to IPOs and in addition to what we hear from these individual companies, too.
Yeah, it's interesting whether or not companies, and a lot of times they're strategic. Going back to the Endeavor deal, I mean, what's interesting is Silver Lake already had about a 71% voting stake in Endeavor. So they already had a very significant stake. And so basically what they did is they offered their minority investors in Endeavor $27.50 a share for their holdings. They put out that statement. So there was already this relationship that was out there. But nonetheless, we're seeing M&A activity pick up. And we've got a great guest to kind of talk about what she is seeing in her particular area of the marketplace.
Yeah, let's bring in Karen Davies, Executive Managing Director for Huntington Commercial Bank. She's here in our studio. We just talked about a couple of the deals that happened in the last few hours that happened today, Karen. But let's take a step back. How would you describe the M&A environment generally right now?
Were you just running from a deal?
A little bit through the raindrops. So thanks for having me back in the studio. It's been an interesting, busy first quarter. We're waking up. we're waking up. I feel like, the M&A market's been kind of asleep for the past 2 years. The capital markets, credit markets have been a little challenged with what we went through on the banking side. But what we see at Huntington, obviously we're headquartered in the Midwest, but a lot of expansion. We're in the Carolinas now, we're in Texas. We have a nice footprint with really nice economic indicators. We're seeing the pitches come up. So we do have investment banking capabilities with our Capstone partners. They said that their pitches are up by 20% for M&A at this point.
Pitches or actual deals?
Well, you got to
forward.
pitch first to get to execution, but pitches are up, and closing of a few of those transactions, both buy and sell side. We're seeing the mega deals come to the market, which you were just speaking to, and that's usually a good indicator of confidence, right? The big ones come first, and then the others will follow. So we think the economic indicators are good. We hear from our CEOs of the companies that we bank, the relationships that we have. There's more optimism, employment optimism, assuming those 3 rate cuts come.
What kind of deals?
Well, that's like we could do a whole show on that.
We could.
Well, we should go there, right? Because you and I feel like we've been having conversations. Okay, we're making this assumption. At the end of last year, markets were assuming 5 or 6, even though the Fed had said it was going to be 3, and now it feels like we keep pulling back. If we don't get those rate cuts, if we only get 1 rate cut this year, how does that change the M&A environment, especially in the middle market space that you guys play a lot with?
I think it will be impactful. I think it'll just slow.
Will it stop them?
I think it would just slow unless it's a very sizable, strategic, synergistic type of deal.
But doesn't it depend on the type of deal here?
It does.
If you're using leverage, then of course rates matter.
That's right.
How much more deals happen based on a 25 basis point rate reduction?
Yeah, that's a hard one to call. I think it'll be an interesting mix of who comes to the table to finance them, right? I mean, you can do it with multiple different vehicles. You can be creative. You can sort of over-equitize on the front end, knowing that the rate cuts are coming or feeling that the rate cuts are coming, because we're actually seeing the divvy recaps come to market now too.
Well, how creative do CEOs want to be in doing a deal, or how much are they looking for kind of a nice, clean deal, very simple?
Well, I guess, again, by industry, obviously, but I think, if you've got really nice financial trends, right, nothing really extraordinary or out of the ordinary in there, you have some nice margins, you have something to offer in terms of technological advancement, IT, AI, something that could be a real strategic, if you're selling, something strategically attractive to a buyer that would really add value while we see where the multiples will go. I think those would be nice transactions. And then some of the deals, retail has seen some suffering. There might be some mergers between those, maybe some vertical integration as well. Yeah.
What about the other side of deals here? Not the M&A and deals, but what happens later? And a different part of the cycle, the divestitures, the spinoffs.
The spinoffs.
Yeah, what are you seeing there?
Not much yet. I think you're going to see more coming because it's been obviously an extraordinary stock market, right? Your publics, your S&P have a lot of cash, and they've been doing quite well, so let's deploy it, right? So it may not be a debt or a leverage play. It's just a pure cash stock type of transaction. And or to boost those coffers more, some divestitures of non-core assets, right? And I do think private credit and private equity are right there on the sidelines.
How much is private equity a part of deals that you guys are either looking at, discussing, thinking about?
I would say it's a good piece of what we're looking at because we have
40%, 50% of every deal?
I would say it's about 30-35% of the transactions that we're seeing on the front end have some sort of connection to private equity because we cover private equity sponsors through our sponsor coverage group. We lend in the sponsor coverage group, and then we have a fund finance team who actually lends to the funds. And then the investment banker. So it's sort of that ecosystem of sponsor.
One thing I wanted to ask you in the notes you shared with our producer, Paul, was that as we just entered the third year of the M&A market pullback, deal makers are anxiously awaiting a recovery, which is expected to be a strong return to near record levels. Do you really think near record this year?
I think 2025.
2025.
If only we get through.
If we get all the rate cuts.
And if we don't.
Maybe I'll have to come back and
we go back to sleep.
Right, we go back to sleep or we sort of lull our way through.
Right. And rate cuts as long as we don't fall into any kind of downturn?
That's correct.
That's got to be the caveat.
That's got to be the caveat. And then there's all the exogenous, right, geopolitical and things of that nature, and we've got an election coming.
Yeah. Does that play into things? How is the election? And just got about 20 seconds
here. I think depends on how you invest. Do you invest on monetary policy?
Yeah.
Or do you invest on politics? I think if it's monetary policy, I think it we'll see later. I don't think it's affecting right now.
Most of the CEOs on monetary policy or on politics?
Monetary, I think.
Okay. Hey, listen, so glad we could catch up with you. Karen,
thank you for having me.
Look forward to next time. Karen Davies, Executive Managing Director over at Huntington Commercial Bank, joining us right here in studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, the next guest was a highlight of this weekend's past Bloomberg Businessweek podcast and broadcast. We actually caught up with our Bloomberg auto columnist, Hannah Elliott, about the influential YouTuber who started an auction house to sell $1 million cars online. That site, Tim, SBX Cars, went live today.
Here to tell us all about it is Alex Hirschi, co-founder of Supercar Blondie, joining us from Dubai, which Caroline, I kind of think, Alex, is a pretty good market to sell hypercars. True or false?
True. Yes, definitely. But there are so many other markets, and that's just why we've started this, because there are collectors from all over the world who want these incredible cars.
Well, talk to us a little bit about the need that you saw and why you started SBX Cars. What was the need that needed to be fulfilled in your mind?
Yeah, well, I've been traveling the world for the last 7 years and meeting collectors and dealers and OEMs. And what I've worked out is that there was no central location for all of these collectors around the world to meet, to buy and sell their cars. And so, I would get calls from collectors and say, hey, listen, do you know where I can buy this car? Or do you know who can buy one of my cars? And I just didn't have the time to connect these guys. So now this platform is what solves that issue. And we're here really to shake up how supercars and premium cars are traded around the world.
Well, and how's, just obviously first day, the auction site went up and running, went live. What can you tell us about early activity actually on it?
Yeah, it's quite exciting, actually. So, yeah, we just went live a few hours ago. On our listings, we have tens of thousands of views already, and we have registered bidders from all over the world. Our latest registered bidder was from Egypt, and then we had one from Japan. So really, they're in markets that we feel are underserved by these in-house auctions and digital auction spaces. There are so many collectors around the world who cannot travel physically in person to these in-house auctions. And so for them just to be able to sit at home from whatever country they're in the world and bid on their dream car from their home is awesome.
So Alex, does that mean they don't get to kind of take it for a test drive or kick the tires kind of thing? Do they just buy it online and they've just got to kind of trust it? How does that work?
Yeah, look, they can go and see the car. We encourage buyers to go and see the cars in person. So the cars are available to go. And, these collectors, it's not the first time they're doing this, right? These collectors are used to buying cars from overseas and shipping them into their own location. So if they have any questions about the car, they can go and send one of their team, their collection manager to go see the car in person. Otherwise, on every single listing, we've got about 150 photos of the car, and the photos need to be super recent. And through our network, we can always make sure that these cars are listed as is.
Hey, I'm wondering about just the development of you professionally over the last 7 years, as you mentioned, and sort of the way that you've built this, not just this media organization, but the way you built this profile within this niche community where you do interact with so many people who can afford these vehicles. I mean, vehicles that are literally one of a kind vehicles. How do you think that car community views you now versus when you started back in 2017 or went full time in 2017?
So differently. When I started in 2017, I came to this world as like a layman, right? I wasn't a car expert, a car journalist. I was just a girl who loved cars. And when I came into the community, it was really male focused. And I really wasn't that welcome, to be honest with you. First of all, I was a woman, which is fine, but also I was coming in from a social media perspective. And the automotive world has really relied on traditional journalists for, since time began to advertise their cars. And coming in from social media, this whole new form, this whole new world, it really wasn't understood. And we were just kind of taken as cowboys, right? But over the last few years, manufacturers now have realized that social media is a crucial way to get the word out about new cars and advertise their cars. So for me to have kind of the biggest presence online for the automotive world has been quite a shift from 7 years ago to now. And now, I'm taken very seriously, which is very nice.
So you are taken very seriously, and I guess that's why people will entrust you with their expensive cars. Like, let's talk about that process, because some of these cars, millions of dollars, there's not necessarily a lot of them depending on the specific car. So how do you actually find them and get a hold of them? Yeah.
Well, I suppose that's also why we're doing what we're doing with this platform, because I have been hunting. That's been my whole job, hunting down these super rare, super collectible cars from around the world. And so doing that, I have developed this network of collectors and dealers who really have the creme de la creme of cars in the world. And it was always really hard for these guys to sell it, because they might know a few people in their own country or in their own network who might want to buy one of these cars. But to reach people outside of their country was really difficult. You had to go through private broker. It would take months and months and months. So for me, I have that network already built. So I have what was really amazing is I didn't expect that kind of feedback from them. They said, take my car, I trust you.
How do you get them? How do you get them to trust you, though? I mean, these are valuable cars, and in some cases, super rare.
Well, they've been trusting me to drive these cars, and and which is just amazing for me. I'm driving $10 million cars that do not belong to me. So the trust was there to be able to get me behind the wheel. And now with the brand I've built and the reach that I have, we get 2 billion views per month on average. And for people wanting to sell their cars, that is really, really valuable. So for them to know, okay, you've got this reach, and you can get as many eyeballs as possible, or more eyeballs than any auction house in the world. Take my car. Here you go.
And you don't have to put up. Okay, I'm being a little silly, but I'm serious, because I'm just thinking, oh my gosh, do you have to put up a bond? Do you have to do anything? Like, do you have to, for them to say, okay, here, take the car and see what you can do? Yeah.
So basically, what's good is the seller just keeps their car where it is.
Okay.
Right. So with in-house auctions, they would usually have to ship their car to wherever the auction is being held, which could be halfway across the globe. They would have to take out insurance. It's a big risk, right? So for us, the seller just keeps the car wherever it is right now, which mitigates the risk. The fees are way lower on the digital platform, because we don't have the millions of dollars that goes into creating these in-house auction spaces, right? So we can keep the fees lower for the buyer as well.
We'll talk a little bit about those fees. Give us an example of the transaction fee that you would take in order to facilitate a transaction here.
Yeah, sure. So for the seller, it's just admin fees. So it literally starts at $250. You can sell your car on our platform for $250.
Wow.
And yeah. So if you want professional photography, we have a whole team of photographers around the world who will come to you in whatever country you're in and actually take those photos. That cost is $950. Then we have our white glove service. So that's when you have a really, really special collection or a one-off car that's worth, $20, $30 million. We can customize the way that we sell that car. We can even have like a preview somewhere beautiful and invite all of these potential buyers. So that's for the seller. The buyer is only 5% on top of the sales price. So when you look at in-house auctions between the buyer and seller, it can be around 15-20%. So ours is 5%, which is a lot less for the buyer.
Hey, just 30 seconds. Are there enough truly rare cars in the world to support your business?
I was asking that when I first started traveling around the world trying to find them, to film them. Now I know there is, because we traveled every single day for 7 years to find these cars, and we found hundreds and hundreds and hundreds of them. So they're all going to be on our site.
10 seconds. What's one real quickly that might be interesting to buyers? Real quick.
Mercedes won, AMG won. It's the first time it's ever going to be up for auction.
How much?
How much? Oh yeah, how much?
Well, we can't say.
Oh,
It
it's an
starts at
auction.
0.
Yeah, but isn't there a reserve price?
Yeah, is there a reserve price?
There is a reserve. We can't say the reserve, but once you near the reserve price, you're going to be able to see it on the site. It'll say near reserve price, and then everyone's like, oh, the next bid, it could sell.
All right. Well, listen, come back soon and we'll check in with how it's all going. Alex, thank you. Alex Hirschi, co-founder, Supercar Blondie. Of course, her new live auction website has just gone up, XBX Cars. Really great to check in with her, joining us there from Dubai.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
TikTok, everyone. We're under 18 minutes till the close of U.S. trading. We just heard the numbers from Charlie and got some details from Bailey, but worth revisiting. The S&P 500 off its lows, but down 0.8%. The Dow down a full percentage point, and pulling up the NASDAQ 100 down right now by just shy of 1%. So off the worst levels of the day, but still firmly in the red.
Dollar index, just checking that out, kind of been bouncing around, but very small moves, just down about 0.2%. So just giving some more perspective. We have seen gold moving up as of late. We saw oil moving up as of late. Concerns over geopolitics, but also supplies. Let's get to it and see what our Drive to the Close guest has to say. Liz Young is back with us, head of investment strategy at SoFi, joining us from New York City. Liz, a lot going on. It does feel like, though, things slowed down a little bit yesterday and a little bit today, and maybe we're just trying to figure out, okay, where do we go from here? How do you see it? What's the big macro think that you guys are kind of all gathering around at this point?
Well, what's interesting is there actually hasn't been a lot of macro news yesterday and today, yet the market has moved quite a bit, almost not in tandem with the news cycle. Yesterday, we had some stronger PMI data. Today, we had some hotter JOLTS data. But a 10 basis point move in Treasury yields yesterday was much larger than I would have expected just on some stronger PMI data. So I think what's happening right now in the market is a couple things. The first of which is that we have to be digesting the idea. I think I heard in the beginning of the show that rate cuts are going to possibly be delayed. Delayed would only be the word that the market could use, because that's when the market wanted them to begin. I don't think the Fed would argue that they've been delayed. I think that they would have said, we never planned on cutting this soon anyway, so it's not a delay. It's actually all going according to the plan that we expected, and we're going to stick to our knitting in the sense of inflation is still not solved. Job market is strong. Growth has been surprisingly strong. So there is no reason for us to be in a rush to cut rates. And I don't think that we should be wishing for rate cuts. That's usually when the market starts to get nervous. So we're in this period of trying to get used to the idea that we're not going to get the cuts when maybe we thought we were going to get the cuts in order to support a high level of valuations. So now what do we do? Where should the money be going? Should it be going to places that are more attractively valued because rates are higher and because they are obviously going to stay higher for longer than we originally expected? So where do we find those opportunities?
Do you think the equity market has fully digested that we're not going to get the rate cuts when we thought we'd get the rate cuts?
No. I don't. In a very simple answer, no, I don't think we've fully digested it, because if you look at what happened from the end of October through the end of last year, we had a rally in higher beta parts of the market. We had a really big rally in smaller cap stocks. We had a rally in things that maybe weren't producing a ton of cash flow, right? The higher risk on type rally. Move into the beginning of this year, and yes, we started to get news originally that, we thought there were going to be 6 cuts, then it moved to 3 cuts very quickly. The market broadly stayed steady, stayed rallying. It just was things came off the bench to hold it up. So I don't think every sector has yet digested the fact that rate cuts aren't going to happen as soon as we expected. What I think the bigger question is going to be, and we all know that this is the question, if and when rate cuts arrive, whether it's this year, next year, whenever the cycle begins, will it be because the Fed is forced to cut rates in response to something? Or will it be because they say, you know what, things are going pretty well, we can start to normalize policy? Obviously, we're all hoping for the latter. And then the last part of it, though, which this is the part that I really don't think markets have yet entirely digested, is the idea that what is normal anymore? What we've been used to as normal policy has been zero interest rates for so long. And what we were at pre-pandemic is just not what the Fed is likely to target this time around as normal. So we have to get to a point where we are comfortable with the 10-year Treasury yield being 2 to 3% higher than it's been for a very long time. And what will that look like for corporate margins and for borrowing costs?
Right. The abnormality, if you will, it was the 0% interest rates, right? And we have to remind everybody that even though it persisted for a long time, that was the odd thing out. Having said that, you know, Liz, we talked earlier with our Michael McKenzie, and I wrote this down because it struck me. He's our rates reporter at Bloomberg News, and he says U.S. exceptionalism keeps reverberating around the U.S. bond market. And I do wonder whether U.S. exceptionalism is also reverberating when it comes to the equity markets. Take the global perspective. There was an interesting story on the Bloomberg about maybe investors thinking, okay, maybe it's time to give up on the India trade and go back to the China trade. And we're looking at Japan and what's going on there. So when you look globally, does U.S. exceptionalism still stand out for investors, or maybe not so much?
Well, in the current state and maybe for the near-term future, the U.S. continues to look like the lowest volatility option. We've still got innovation happening here, obviously in technology and all of the enthusiasm that's going on around AI. But you also have a dollar that continues to stay strong and appreciate. We've got, you know, currency volatility around the globe that has picked up quite a bit in the last month or so. And I think that's given investors some jitters. And then this climb in gold, I think, is in response to a lot of that currency volatility around the globe. So if you're looking at the U.S. as a place that is producing solid growth above expectations, is producing solid earnings growth above expectations, without yet seeing a lot of pain in things like the labor market, and with an inflation rate that has come down quite a bit from its peak, yes, it would look like the U.S. is still the best, the whatever you want to call it, the cleanest dirty shirt, the best house on the block, bad block. And that is still true today. And I think that the capital will continue to stay here, if not flow here, until that becomes untrue. What's going on right now is that this pause in the rally, I think, is giving investors some reason to start to second guess, okay, is there another leg up? Is there more growth available in the U.S. because we've been riding this U.S. wave for a long time? Is it time that we start looking outside for other pockets of growth? And I'm sure there will be other pockets of growth. It's just that you have to weigh the risk reward. And the fact that currency volatility continues to play a part in a lot of this narrative is something that just does not sit well with me at night, especially when we're looking at the moves in commodity prices and all of the geopolitical risk that continues to come out of Asia.
Yeah.
A lot to keep in mind.
Yeah, there's a lot. That's why I said I kidded with our Michael McKenzie earlier. Like, I want to kind of just do fast forward because there's just a lot of stuff coming at us.
Well, close your eyes and we'll be there because we're already in the second quarter of the year, Carol Massar.
It's a good point. All right, Liz Young, thank you so much. Be well. Head of Investment Strategy at SoFi, joining us right here in New York City.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.